Hello, everybody. This is Adam Russo at the Phia Group, and welcome to What We Love About Self-Funding in 2019, our Valentine's Day edition of our monthly webinar. A lot of love in this room, Ron.
I'm feeling it.
It's amazing. Folks, I missed last month, and Ron loved to gloat to me that it was the highest attended webinar ever. But people did not know that I wasn't going to be there, Ron. If you said that it was the highest rated one ever, and people knew that I wasn't going to be there, that'd be one thing. But they didn't know. They still logged in and then found out, and were disappointed.
I disagree, Adam. If you look at social media, you have such a following. Everybody knows where you're going to be every minute of your life. And so your groupies were tracking you, which means the only people we got on the webinar were the leftovers.
I guess you're right about that. Folks, happy Valentine's Day to all of you and your loved ones. Today's speakers, as you can see, you know, that really good-looking guy on the left, the not-so-good-looking guy next to me, the beautiful Jen McCormick, and last but not least, the also not that attractive Brady Bizzarro. Folks, go back to that one for a second. Is it safe to say that all three of us on the left don't have dates tonight? We're not going anywhere because we're married.
Correct.
We literally have married with kids. So maybe, you know, we might get Domino's delivered like at 9 o'clock. I mean, other than that, we're not going anywhere, correct?
Yeah, if they can deliver a heart-shaped pizza, that's about the best I can do.
And Brady, I'm going to ask you right in front of all, you have hundreds and hundreds of people that just follow you. You have a lot of fanatics. Brady, do you have a date tonight?
Saturday, not tonight.
So she's going out with someone else tonight. And then she's taking you out on. Are you serious?
Well, there's too crowded.
Folks, feel free to text us in if you actually believe that this girl is I'm assuming it's a woman. This woman isn't going out with someone else tonight. I would like to get a poll on that.
That's when he walks the dogs at the shelter.
Folks, as you can tell, we're all just in a really good mood today. Please feel free to follow us on LinkedIn, #SaveMaxJob. We hit that $3,000 figure, 3,000 follower figure a couple months ago, but now we want to get this to how many?
Yeah, we kept Matt on the job,
right?
Unfortunately, so now we've created another threshold that we have to be.
We have to make sure we keep that threshold going up, up, and up. Also, folks, as you know, we do some amazing podcasts. The Faces of Phia, I believe we're on number 10 already.
Yeah.
It's gotten really positive feedback. What it showed us is this, that people don't actually want to hear our podcast about anything real. They don't want to talk about healthcare or politics. What they want to talk about is Norma, who works in our accounting department. That's what they're interested in, which is great. Folks, as always, please feel free. We're already getting an email. Look at the question we're getting. The first question we get isn't like Happy Valentine's Day. It's how much 340B expertise do you have? We have none. Hang up the phone, Kevin. We don't want you to talk to us. You're getting too serious way too fast. Of course, you can reach out to us. And looking forward to working with you in the future. Folks, every month we do a shout out. This month is no different. Happy Valentine's Day to you, Chrissy, from CBS Custom Benefit Solutions. She has been an avid fan of all of our podcasts. She sends love letters to Ron, Brady, and myself all the time. Thank you so much, Chrissy, for listening. We will be sending you an amazing Phia Group goodie bag with a picture of Brady signed, autographed photo of Brady, like a heart locket shape.
Yeah.
Like a really small one that she can wear on a necklace or something. You'll be getting that sent over very soon. And again, we are very humbled and grateful that you listen to us every single month. As you all know, the most recent face of Phia, Ashley Turco, our Director of Compliance, who has literally been here since we started the company. Lisa Taney, the controller. If you don't know what a controller is, like I didn't know, and I actually pay her a salary, no idea what a controller does. She is also on our Face of Phia podcast. And last but not least, who comes up with these poses?
Honestly, you know,
where do we get? Like, who told Christine that looks good? Did someone tell her that pose?
It's a power position.
Is it a power position?
Yeah, it's how you assert yourself. The hands on the waist.
I don't know.
I think it looks good.
I will admit Lisa looks a lot more relaxed compared to the other two.
Lisa looks too relaxed. So someone is controlling all of our money, and I'm not so sure about that jacket or whatever. The little, it's like a nun or something with those. Anyway, the Face of Phia, if you can't tell by now, it's a lot of fun. We have a lot of fun with our employees, but it's always great for you all to see who the real people are, who are actually trying to do everything possible to make money for this company, not just waste money as I'm doing by being on this webinar today. The overview, folks. Problem, purpose, process. Last month's most frequently asked question in PGC, the lovely Jen McCormick, will do that for us today. A political update from Brady Bizzarro. We promise you we'll keep it to 10 minutes or less, even though he'll try to take over the entire webinar. And then the Valentine's Day edition, what we love about self-funding. This is really cool stuff that we're going to talk about. We have some real data, some really cool things, customization, cost containment, and systemic change. So with that, folks, don't forget the reason why we're here. If you're not able to answer the question why your company exists, find another job. The whole purpose of this is to tell everyone why we're here. We are here to make health benefits more affordable. Why? Because every hardworking American deserves access to high-quality, affordable health care. Folks, one of the biggest things that we're noticing, PBM, specialty drug spend, is on the rise. We know that it's 50% of all healthcare spend. It's going to keep going up. Please stay tuned. Phia will have real solutions able to offer to all you folks in the short few months. So we're going to keep you posted on that. Speaking of special, specialty drugs, we're going to turn it over to our special VP, Jennifer McCormick. Please take it over from here with PGC's most frequently asked questions. Take it away, Jen.
All right, thank you. Okay, so I know there's a lot of text on here, so I'm going to explain everything. Last month, one of the questions that we were getting, maybe because it was the beginning of the year and out-of-pockets were resetting with all of these calendar year plans, was how does the out-of-pocket maximum limits actually impact balance billing? So this goes back to the requirement as it stands under ACA now that once a plan member hits their out-of-pocket maximum, everything needs to be covered under the plan at 100%. That means that there's no more deductible, no more co-insurance, and no more co-pays that the plan participant must pay once they hit that specific amount. What is not included in what I just said is balance billing. So once you hit your out-of-pocket maximum, that means that balance billing may still be permitted. However, there are a lot of times when a provider is trying to appeal a claim and argue that once an out-of-pocket maximum has been met, that the plan then has an obligation to pay everything in 100%, including that balance bill. But that is not the case. So the fact that a balance bill is being argued that needs to be included as part of that out-of-pocket maximum is just inaccurate. If you actually have any of those cases, you can kind of send them over to us so we can provide our commentary on it. But the only thing that is changing is if the copay, the deductible, and the co-insurance aren't going to have to continue to be paid by the plan participant. How and what the calculation is being used to determine what is payable by the plan is not impacted by the ACA out-of-pocket maximum rule. Next, we're talking about the self-inflicted injury exclusion. So this is something that has also recently come up, obviously, as part of our PGC FAQs, and we can't talk about a self-inflicted injury exclusion without talking about the HIPAA source of injury rule, right? And so the source of injury rule is the rule that tells us that it's creating an exception to the exclusion. And it's saying that if something, the source of something, resulted from a documented medical condition or from being the victim of domestic violence, then you cannot exclude those claims.
So Jen, just so I understand this, right, I've always thought about this. The medical condition exclusion to the exclusion.
Mm-hmm.
Can't somebody just argue anytime there's ever a self-inflicted injury, can't the person who, I guess, or their family, if it didn't work, right, if they try to kill themselves but they didn't die, right, but there's a lot of medical bills,
Sure.
Can't they just make the argument, I have a medical condition?
Special
Right.
mental health, yeah.
Yep. So
Can't they always get those claims paid?
it's very rare that you're actually going to be able to apply a self-inflicted exclusion. And
Have you ever seen it, that it's actually upheld?
Yeah, so one of the things that you see a lot of plans and TPAs and carriers doing when they're looking at an exclusion like this is they'll actually look back at the person's medical history and see if there's any claims for past treatment.
But even if there weren't, I mean, I'm assuming everyone has their first time they try to hurt themselves.
Right.
But they could always make the argument that there's something psychologically wrong with me.
Absolutely.
And that would then get around the exclusion, right?
So the way that we always try to explain it and help people, particularly with plan language, right, because this always goes back to the plan language as well as actually having this exception to the exclusion, is there any sort of documentation, right? So and the documentation may be part of the medical notes, maybe part of the review, but the important lesson here is that that documentation doesn't necessarily have to occur prior to the actual incident. It can occur after or maybe concurrent with the particular circumstances.
So speaking of self-inflicted, Jen, I see you broke your finger. Was that self-inflicted as well?
I owed a guy some money, broke my finger, so
I just noticed that for the first time right now. But
you opened the sports books in Rhode Island, Adam, so now you're some people some money.
Oh, I see. So the bottom line, though, is this is a tough exclusion to apply.
Yeah.
It is. But our rule here and the way that we can assist is making sure that you actually address the source of injury rule within your plan language itself.
Good. The next one I think is really, really interesting because I hear about this a lot on the road. Can you get into that a little bit for us, Jen?
Yeah, DPC, or direct primary care coverage. I know Ron's going to go into this a little bit later today during the webinar, but the concern that people are having is this is really important. This is a sexy thing for plans to do for 2019, and people are running into a bit of a problem because they have a high deductible health plan that's covered with an HSA. And what do we know about that? Well, we know that the plan can only pay first dollar coverage prior to meeting the deductible if it's for preventive services. And direct primary care is much broader than preventive services. So there could be a situation here.
Well, it includes preventive services potentially.
Some of them may be preventive services, but not all of them.
Right.
So under the IRS rules, in order to prevent the plan from being disqualified and creating adverse tax consequences for the employee and the employer, there needs to be some way that a plan, particularly an HDHP, a high deductible health plan, can integrate and incorporate some sort of DPC coverage. So there's a couple of ways to do it. And I think that the more responsible way to do this without having to create tax consequences, adverse tax consequences when you have a high deductible health plan, is finding a way that the plan participant is actually paying for the cost of coverage until that specific deductible is being met. There are opportunities for a plan to potentially pay for this outside of the plan and setting up some sort of employee-employer relationship where the employer is encouraging people to go to the DPC outside of the plan. But then that could create some potential rules of having other plan coverage and also violating the IRS rules. So the long story short here is, if this is something that you're wanting to do, make sure that you can calculate a way that you can control what the cost would be per visit, and you're charging those participants for that service prior to the deductible being met.
Jen, great job as always. I know Brady's like shaking.
I know.
He was dying for Jen to know that.
I know what's coming next.
I can't. Can you believe it? We're going to talk politics.
It's Brady time.
It's Brady. Brady, we're all just going to leave, go to the bathroom. We come back in about 10 minutes. We'll give you the 10 minutes to shine. Go ahead, buddy.
That's fine by me. I think most of our listeners would like that. So I want to talk about the state of the healthcare union. Last week, I think it was Monday night, a delayed State of the Union address was given by President Trump. And of course, I watched it at least 2 or 3 times to make sure I caught everything that was said about healthcare, because let's face it, one of the things Adam brought up, prescription drug prices, protecting people with conditions under the ACA lawsuit. These are all big issues that are currently in the news. The president's been talking about a bunch of different things, but on healthcare, there are a number of topics that appeal to both sides of the aisle. And so I jotted down a list of the top things I heard that many of which apply, or all of which apply in some way to our industry, some more than others. But we'll talk briefly about some of these. Prescription drug prices being number one, and I have a whole slide about that, so don't worry. Price transparency, another thing that's a big topic right now, and includes a new recent CMS bill or rule that was passed that has required hospitals to post their prices online. We did a whole podcast about this recently with Philip Coelho from our office about what that means for you and sort of the reaction in the industry to that. So I would encourage people to check that podcast out. Also a blog on it as well. Nationwide paid family leave, that's another huge issue that was brought up. It's accounted for in the president's budget. I'll talk about in a second. And the ACA, what's going to happen with this lawsuit? There's an update to give. I'll give it. The president also called out, he gave a shout out to the right to try legislation, which we've also, I think Jen's written about that extensively. That's on our website and you can find it there. And just general deregulation. What else is being chipped away from the Affordable Care Act? And there's a lot to say on that. But the top of the list, not surprisingly, is drug prices. And so Adam mentioned this is 50% of really all claim spend for self-funded plans is probably going to get higher unless, of course, some of the actions being proposed by the administration take effect. So the problem, though, that has been faced by the administration so far up to this point has been critics are saying that it's all just talk. Where's the action? A lot of rhetoric. We see the blueprint come out. If you listen to our earlier podcasts and webinars, we talked extensively about that. But what is actually being done? We know that PBMs are being sort of attacked as the shadowy middlemen here. Like it or not, that's been the approach that they've taken. We know that there's been a lot of tweets against Big Pharma directly, and some of them have responded by lowering their prices temporarily.
You know what? I mean, I listened to what you said, and I think, I'm guilty of this as well. I think I've always placed the blame on the PBMs and the manufacturers, but I think a big part of this is also just the doctors, the physicians themselves. So what I learned actually earlier today, I had a meeting with an organization. It's about doctors not even knowing the prices of any of these drugs that they're prescribing. No idea. Or doctors being told, hey, you realize that you gave us a prescription for this particular drug, which is $5,000 a month. That drug is actually a combination of two separate drugs that are both generics, which if each of them available is $5 a piece.
Right.
Couldn't that person just get 2 scripts of these 2 drugs and take 1 pill each? And the doctor says, yeah, of course they could have. What do you mean that's $5,000? I would never give him that script if it was $5,000.
Right.
So a lot of it is behavior too. There all are, sure, are there drugs, and are there certain specialty drugs, for example, where there is no other alternative other than that drug that's $100,000? Sure. But what I have seen, for the most part, even generics, typically you could roughly save half of your generic spend by just people using those drugs appropriately and being prescribed those drugs appropriately. Right. I think what we're going to notice going forward is, in addition to this, reducing the prices, but actually educating members to be not only patients of healthcare, but consumers of healthcare, where they actually know the pricing related to the drugs they're buying. Right. There are drugs right now that you're paying $3,000 for the pill, but you only have to take it once a day, but for $3,000 a month. But it's $100 a month if you actually take the pill twice a day. It's just different strength. But and people are paying the $3,000 one, not being told about $100 one.
But Adam, so to your point, when you look, for instance, at efforts underway to get pricing added to advertisements and television advertisements, and we talk about this with transparency in general all the time, and I know I go off on a tangent in our recent podcast, Brady, and that'll be posted, you do. My issue with transparency, again, is on its own, it doesn't really do all that much because, yeah, now I know how much the drug costs, but if I don't know what the alternatives are, I'm thinking, well, I guess that's what I need to pay because that's what I need to take.
Right.
Yeah. It's actually worse than Adam even said because the pharmacists themselves were previously, and in some cases still are, barred from even telling you the generic prices. The gag rules existed. So even if they knew of a cheaper alternative, they weren't even allowed by law to tell you.
Unless you ask.
But who thinks to ask? Let's be honest. I mean,
well,
Jen would think to ask.
If you were working with the right administrator or right broker,
you would.
So you would. That's the whole point of this.
Sure. But so we're talking about action and what's actually being done by the administration. They have proposed removing and repealing many of these gag rules to allow pharmacists to offer you that generic drug. Other things that they've been doing, and Ron just alluded to it.
Brady, we're still not giving you more time, even though we talked.
I'll try not to talk too fast then.
He keeps kicking us. Tell us to stop talking.
This is a big issue. It's a big deal. It's an important thing for people to know that very soon you may see companies, you've already seen one, Johnson & Johnson, is announcing their list prices on TV ads. Now, that's a proposed rule by HHS that would actually require all drug manufacturers to do this, or the wholesale acquisition cost is another word for the list price here. And it's really about price shaming. The thinking is that if we can get manufacturers to be upfront on TV ads about the prices, maybe they'll be shamed into lowering the cost. Now, this proposed rule will be limited to drugs that are covered by Medicare and Medicaid, and not all drugs are. There are drugs for anorexia, weight loss, weight gain, and fertility drugs that are not covered. So we have to see this rule expanded. But for now, it's a good start. But what Johnson & Johnson has done, very smart on their part, they're disclosing the price, not the list price, but the price that's paid by the consumer on the back end. So after the PBM negotiated the discount, after the coupon card was used, we want to know those real list prices because those are the real shocking prices. So I think that'll be a good first start if these rules go from being proposed to becoming final rules. Another one that's, I think, very, very important to bring up is there's a proposed rule that would require in certain cases, the tying of a price of a drug to an international index. And this is the rhetoric you hear about the freeloading problem where, other countries are getting to rely on the U.S. And our ingenuity in inventing new pharmaceuticals. And so maybe floating the idea or the threat of tying pricing to an international index could be a big deal. One last thing I want to mention on action here is a proposal that was introduced last week by a prominent senator who's running for 2020 along with everyone else, a bill that's called the Medicare Negotiation and Competitive Licensing Act. And it's an idea that Republicans themselves, including the president, have floated around before. And that's the requirement that manufacturers would have to negotiate directly with the largest purchaser of drugs in the country, which is Medicare. And if they didn't negotiate in good faith, and I'm making air quotes that you can't see when I say that, because if it's not done in good faith, then the manufacturer would lose their patent to that drug, which would mean that a generic alternative could be introduced to the market a lot sooner. And that's a big deal because they're much cheaper, generally speaking. And this bill has already been signed on by a number of people running for election: Senator Warren, Bernie Sanders, Kamala Harris, on and on and on. I think that because that's the case, and because Republicans have also introduced or at least had the idea for this, I think we could see some kind of rule proposed that might actually require Medicare to get involved and negotiate with these drug manufacturers. That could be a big deal. The reason it's a big deal is because it could establish a benchmark pricing, a Medicare-like rate for drugs, if you will. We have that for most other medical services. We don't have it for drug pricing. If we did, if a PBM or a plan could point to publicly posted price information by Medicare and say, here's what Medicare pays, we're not going to go with our PBM contracts and our network rate. We're going to pay an out-of-network type claim for this drug. We're going to pay Medicare plus 150. That could be a huge game changer, and that may happen. And if it does, I know I'll be first to know about it, so I'll make sure that you guys know about it as well. But I think that'll be a good impact on self-funded plans. At the least, though, I think transparency is a step in the right direction, and I think that's likely to happen before we see legislation on this topic passed. All right, now another big topic that's related to self-funded plans is this proposal for a federal paid family leave law. I know that excites Jen a lot because we've written about this before in the past. We've seen tons of states introducing their own bills, including New York, which has already passed their own Family Leave Act, which is paid. Massachusetts' law goes into effect in 2021. Rhode Island has one, and on and on and on. But this is an issue I think will be very important this year because the president's daughter and advisor, Ivanka Trump, this issue is very important to her. She's been to Capitol Hill, met with senators on both sides of the aisle on this issue, and the president mentioned it in the State of the Union, said he's got a plan for it. It's already in his budget. If you recall, the Tax Cuts and Jobs Act included a pilot program for employers who wanted to provide paid leave and offer them a tax incentive to do so. So what would this kind of bill look like? Well, there's a lot of questions, right? Is it going to be just parental leave, which for now is limited to new mothers and new fathers and adoptive parents, or would it be paid family leave, which would expand the requirement, maybe more comprehensive? It would apply to caring for sick relatives or domestic partners or stepchildren. We'd have to wait and see what it looks like here. It also would probably preempt these other state laws, like in New York, unless those laws are more generous, which in New York's case it could be because it's going to be up to 12 weeks of paid leave. And also, who pays? Is this something that's shared between the employer and the employee through a payroll deduction, or will the employer have to foot the whole bill? Probably unlikely. But for our purposes, this is important because obviously it would impact the requirement for the employer to continue health coverage during the leave. So whereas FMLA already has that requirement, this could be an added requirement. It may not be congruous, if you will, with the FMLA, maybe a separate requirement. It could be longer than 12 weeks. We just don't know yet. But it also, frankly, and the rhetoric in the country over this issue now will tell you it's a good benefit, generally speaking, to provide to employees, right? If you're going to provide paid family leave, you're probably going to help attract and retain your good workers. So I think this is the direction we're going in. The president is already working on a plan with Bill Cassidy, Republican from Louisiana, on a bill, the beginnings of a bill that could take shape this year, and we'll bring you developments on that issue as well. A few quick notable mentions. I've gone over time here, but I think it would be remiss of me not to mention an update to the ACA lawsuit. As everyone who's following us knows, this big case out of Texas where a federal judge declared the ACA unconstitutional. It's since been appealed to the Fifth Circuit Court of Appeals. That's been stalled because of the government shutdown, but the House has obviously flipped to the Democratic control, and they have signed on to join the lawsuit defending the ACA. In the meantime, though, the House has been passing, or is looking to pass, they've already voted to intervene to defend the ACA, I just said that, but they've also been passing some bills to try and rectify some of the damage that they say has been caused to the ACA by the Trump administration. One of them would be to repeal the expansion of short-term limited duration health plans, which didn't have to follow many of the ACA's requirements. Another would be to increase funding for ACA enrollment. We'll follow and watch that. But for now, like we said before, still comply with the ACA. It's still the law of the land, and we expect maybe in Q3 of this year, the Fifth Circuit to actually render a decision in this case. But it's a big deal. And it's also a big deal, ACA that is, for 2020. You hear about it all the time in the news. You also hear a lot about Medicare for all and, the end of private insurance. That's probably not going to happen. We're not thinking that's going to be the case here, but it's important to understand for our purposes why self-funding, why we love self-funding, and to convince others why they should love self-funding too, especially where we have all this rhetoric about Medicare for all and people criticizing employer-sponsored insurance. So what better way to love self-insurance than to talk about why we do so? And for that, I will turn it over to Ron.
Yeah, Brady, I'm really glad you mentioned that, and that's really the theme of the day, is what we love about self-funding, because I think you're right. Often, if you listen to our podcast webinars, other people's podcast webinars, one thing that you notice that's almost universal in our industry is we're all talking about the problems, right? Threats to the industry, costs that we're trying to overcome. And it's great. It's important to recognize the issues and try to come up with solutions. But if you step back and look at it from that 30,000-foot level, you ask yourself, well, why are you trying to save self-funding in the first place? What makes it worthwhile? Why is it worth saving? And for the remainder of the hour, we're going to actually talk about what it is about self-funding that makes it worth saving in the first place, and why we think it's such a great opportunity or way to provide health benefits moving into the future. If you are somebody who has provided health benefits in the past and done so in a more traditional, fully insured way, is self-funding right for you? And if you look at the rate at which employers are becoming self-funded, it's apparent a lot of other employers and organizations out there agree that there are these benefits to self-funding. And we could talk about the classics, right? All the things people know about, for instance, that, the funds still belong to the plan until they're actually used. So as a result, all the interest, all the benefit of money held versus money paid, it goes to the employer, to the plan sponsor, rather than a carrier if you were paying them premium up front. There's things like customization, right? Plan documents, and we'll talk about those things. There's tax benefits. We're not going to go into that because I'm afraid of math. But right now what I want to talk about are some of the more innovative things you can do with a self-funded plan. And the first thing has to do with things like tourism, direct contracting, basically how you work with or collaborate with providers of healthcare. And I'm on the record as having said that I feel like the adversarial position that we as an industry, as payers, take against providers of healthcare, I understand why we often take that position, but ultimately, if somebody else is outside the industry looking in, we are healthcare in general. Okay, we're one industry. And the fact of the matter is there are many providers, I would argue more rather than less, that understand that if we can't get this entire system to work, then we're all going to be in trouble. And you talked about Medicare for all as being one example where things could go poorly. So there are many providers out there that are looking for ways to work with the payer rather than against the payer. And as a self-funded plan, you have the ability to engage in these discussions, in these conversations, in this collaboration with providers. Direct contracting with individual centers of excellence, either in general or for specific types of care, like transplants, implants, whatever. Oncology is another example, right, where you see these centers of excellence. Tied into centers of excellence, obviously, is domestic tourism. Right? If there's only one or two facilities within a certain distance of my organization where my employees, my plan members work and live, if they're not willing to travel, my options become limited. But if they're willing to travel, all of a sudden those options expand. If you have a few of these negotiated providers, have you formed basically a narrow network. And by having a narrow network, because there's steerage tied to narrow network, you're offering more value to the provider, and so in exchange, the providers are willing to offer you more in the ways of cost savings. And of course, direct primary care, well, I'll talk about in a second. When we talk about all the reasons why you can't do this type of thing, it's not tied to self-funding. Being a self-funded plan empowers you to do these types of things, to travel and to negotiate direct contracts. What prevents you from doing this is outside third-party contracts. As a self-funded plan, a fully insured policy, it doesn't matter. If you have executed a third-party agreement, usually you see this in the form of a PPO contract, that agreement may be what limits your ability to negotiate either with in-network providers, to negotiate with providers in general, to steer people to one in-network facility versus another. There's a lot of misunderstanding out there that you cannot do these things because of ERISA or because of the ACA or because of something having to do with your plan document. Not true. It's third-party contracts, and if you violate the contract, you'll probably be sued for breach of contract. It has nothing to do with self-funding. Self-funding gives you a tool to do this. It's not the hurdle. So speaking of one of the things that you want to at least try to do, if possible, is direct primary care. And direct primary care often gets confused with things like telehealth. And I would argue that, while telehealth is one tool that certainly has its value, I believe it's one tool that's wrapped up into the toolbox that is direct primary care. We here at the Phia Group actually have engaged with a direct primary care physician for many of our plan members. And I myself use Dr. Tremblay. He's our direct primary care physician, and the experience has been fantastic. Regardless of where you're located, you can contact him. He knows your history. He communicates with you right away. You're able to get into the office right away because it's structured around a capitated subscription fee. The physician is less concerned with trying to grind out as many patients as possible to bill as much as possible. They've already been paid. So as a result, because he's able to budget ahead of time, he's able to take on less patients. And as a result, there's more time in the day to actually have you in and spend the time with the patient diagnosing the issue. Additionally, and this is a less known or less spoken about benefit of direct primary care, is that because this physician has a relationship directly with our plan, he's familiar with the terms of the plan document. He's familiar with what's covered and what's excluded. So he knows not to send me somewhere that's going to cost me or the plan more than somewhere else. He's almost a air traffic controller for the plan and the members. He's that collaborating with us rather than against us. And so he's able to communicate with us and tell us, hey, look, we've been sending out, this is just an example, all of the lab tests, the diagnostics to this lab, and we've been checking their prices, and we think that we could get it at a different lab for less. Well, because he's not getting paid per service, it benefits him to keep our plan healthy, financially and otherwise, and therefore he's able to steer us to this other lab. And so he's a partner in providing quality health care for less cost. The last thing I'll mention about direct primary care, however, that because this is a health benefit, if you're going to pay for it through your plan, first of all, the direct primary care physician may not be willing to accept insurance or a plan. Some of them are so sick of insurance and PPOs and everything, they just refuse. If they're willing to accept payment from the plan, however, because it's a health benefit, you're going to have to offer it to all plan members. And because it's a capitated subscription fee, you may be paying for, let's say you have 200 members on your plan, you're paying for all 200, and maybe only 50 of those people actually use this physician. The other 150 employees, plan members, they have their own physician, their own PCP, they don't want to leave, they just don't want to go, they think they're invincible, don't need care, whatever the reason. So one thing that you may need to do in order to at least limit that exposure is ahead of time determine who's actually going to utilize this direct primary care and who will not, and potentially offer two separate plan options. The people who are going to utilize DPC, they enroll in option 1, which includes direct primary care, and then those who won't, number 2. Now again, in order to do that, you need to make sure that that direct primary care physician is on board, understands how you're doing this, and isn't finding out only after the fact. If they thought they were going to get all 200 people when they agreed to their price, and then you're paying them for only 50 every year, that's not going to really work out too well either. So again, it's all about collaboration, it's all about cooperation, and as a self-funded plan sponsor or someone who works with a self-funded plan, you actually have the ability to do just that. And speaking of other things that you can do, I think the most important thing is looking at the data to steer you. The data is what's going to tell you what you need and what you don't need. And when it comes to talking about the important stuff like data, I'm going to back off and give it back to Ted.
All right. Yeah. Who doesn't love data, right? Obviously, one of the most important things and one of the most important tools that is a benefit specific to being self-funded. Because if you are not self-funded, you don't get that type of direct access to all that really important information that you can really use to customize the specific benefits that your plan might offer. So for example, One of the things that you'll have the benefit of in being self-funding is over the course of the year, over the course of the plan or calendar year, you're going to know exactly how much money your plan is spending on benefits. And don't you think that'd be a real opportunity to use that data, that knowledge, the cost that you had incurred for your plan participants over the course of the year when you're shopping around for stop loss coverage? Maybe knowing that can be a leverage or maybe a bargaining tool that you can use when you're speaking with the different carriers, knowing exactly this is the data that I can show you about how much I expect my plan population to spend over the course of the year. Obviously, it's not going to be perfect, but you're uniquely situated by being self-funded to have that information. Next is there something in looking at your current population, looking at that data, are you seeing that you're spending 10x on a particular service, or maybe you're not spending enough on this benefit? Maybe that could be an opportunity for you to look at that data, look at that claims information, and try and negotiate with a particular vendor or even carve out a service. We've been talking about the high cost of specialty drugs. Are you looking at that data? Is that something that's particularly impacting your plan? Is that a problem? Well, by being self-funded, you have a real opportunity there to make changes, plan design changes to your actual benefits. And obviously, it's outside the scope of our conversation today about how logistically that needs to get done. But keep in mind that when you are self-funded, you're going to have the opportunity to take that data, to look at the actual plan benefits that are being used, maybe over or underutilized by the plan participants, and use that information to target particular ways that you can find a better use for plan money. Next, I know that we're talking about the positives here, but when we're talking about fraud, waste, and abuse, the positive is making sure that you're on the plan, you're on the lookout for that. So do you have conversations with the staff, your staff or the employee population? Are they aware of all of the fraud, the waste, the abuse that exists? For example, as Adam so kindly noted, I did break my finger, I fractured my finger, and I needed to have services in order to treat that. There could be an opportunity where I had gone to the doctor and the doctor said that, yes, you fractured your finger in multiple spots, I'm going to put a splint on it, and I'm going to need you to come back in a month or so and make sure you don't need to have any other follow-up procedures. And what if the doctor in that case, instead of billing to put a splint, had billed to put a cast on my hand? I don't even know if that's possible. But what if they had gone through the process and made all of these extra billed charges and things that actually I hadn't incurred? I, as the employee and also the patient, I should be empowered to take a look at those bills and make sure that the plan is actually only being billed for the services that I've received. So there's a real opportunity when it comes to being charged for services that didn't actually occur, or if there was some sort of situation where they're billing for services, whether it's upcoding or upbilling or all those other unique terms. You really need to empower the employees to look at that and make sure that there's not only something that they're aware of, but there are plan design ways that you can address that, reward them, and incentivize them for looking into that to prevent those types of things from being perpetuated. And before we kind of switch to the next thing, there isn't really opportunity to customize benefits. One of the things that we have done here that I think is really powerful is by asking our employees, what benefits would you like to see under our plan? Is there something that we're not covering that you want to cover? And that's not something that you're really going to have the opportunity to do elsewhere. So if there's a particular benefit that may be beneficial for employees, they might find that of value, like adding DPC. That was something that was really valuable for our plan population. And we were able to customize our benefit, change our plan design, and keep them happy, right? So it's not only something that is going to be beneficial for our plan population and saving costs, but it's also important for morale. Because after all, our health plan is an employee benefit, right? Okay, and talking about that, our employee base, you should take a look at your population. You should know exactly the type of employees that you have. In addition to the examples up here, whether they're smokers or skydivers, which obviously everyone at Phia is, do they drink and drive? I mean, I hope not. Are they a healthy population? Is it a bunch of lawyers who sit at a desk all day, or is it a bunch of people who are on the road constantly driving different places for meetings and things? Knowing your population is going to help you to decide the type of benefits that might be beneficial for you. But in addition to deciding what type of benefits, Maybe it's going to help you decide what your risk might be if you needed stop loss, for example, decide what your deductibles might be based on the risk of your population. And knowing that you have a generally healthy population, maybe spending a ton of money on a wellness program isn't suited for your population, but maybe offering some sort of reward for going to the gym would be something they'd be looking into that would be beneficial for that planned population. And also in talking about customizing, you have the opportunity to decide what type of coverage you're going to be offering to your employees. Do you want to offer coverage to just the employee plus their spouse, the employee plus a child, the employee plus 5 children, or entire family coverage? So when you're deciding your benefits that you're offering, not only do you get to decide the scope of what is offered, but also who it is offered to. So take a look at that. Maybe that's a way that you could really offer that flexibility and find something that the plan would want. That's something that we actually did here too. We only used to offer 2 tiers. It was an individual plan and a family plan. And as our employee population was growing and changing, we realized that we had a lot of employees who were getting married and wanted to add their spouses to the plan. So we modified the tier of coverage that we offered so we could offer that as something that maybe hadn't been offered previously. Next, I'll talk about, sorry Brady, I know that you're really excited to kind of move on.
Next slide, yeah.
But we're talking about different networks and different options for things. When you're trying to customize the benefits and the things that might be available for your planned population, you can really change benefits and carve things out or customize things based on particular types of treatments. But as always, it's a recommendation that you don't do that based on a specific diagnosis or disease. So just be careful when you're making these customized modifications that suit your specific employee base, that you're doing so on a broad scale as opposed to a specific diagnosis or disease. Now you can go.
Now you can go. I was excited too. So here we have Jen talking about how by looking at the data as a self-funded benefit plan, you actually get to look at your own claims data and customize your plan to fit the needs of your plan population. I'm going to talk a little bit about how data transparency not only lets you customize your plan, but also lets you monitor third parties. And I've already mentioned once before that you may have signed some sort of a network contract or third-party agreement that limits your ability, A, to audit the information, and B, even if you can audit the information, you're limited in what you can actually do with it. Okay. Setting that aside for a moment, and that's a whole other conversation, let's say hypothetically you actually are not limited by some third-party contract from reviewing your claims data and making determinations. Looking at the claims data, our own company, right? We have a number of employees. It's a wonderful thing where for a while there, the most regular source of medical claims for our company was childbirth. All right, for whatever reason, one year, everybody decided they were going to get pregnant and have babies at the same time, which is great if you're one of the local daycare facilities. But anyway, so now, just because everyone decided to get pregnant and have babies at the same time doesn't mean that all of a sudden everybody is going to go to the same facility to give birth. Aha. So now let's say we have numerous people and they're all giving birth at the same time, but at different facilities. Right? Different facilities. The claims come in. Thanks to data transparency, we can actually look and say, hey, did you notice that this hospital charges way more than that hospital for the same service? Oh my, right? Or, hey, have you noticed that at this facility, people seem to suffer more complications and we end up being charged for it than at that facility? And slowly but surely, you start to recognize which facilities charge less and provide higher quality care. And that's the kind of information, that's the kind of transparency that I like. I know I knock transparency all the time, and I say just knowing the price of things doesn't matter. But if I can tell somebody, not only does this place cost less, but the quality of care is higher, now you know. Now you know something you didn't know before. And I like to compare it all the time. I talk about the Tylenol example, right, Brady? You're getting sick of it at this point. But my example of transparency, and I say it all the time, if you've heard it, stop me. Going once, going twice, okay, I didn't hear anybody. Where you walk into a local pharmacy and they have the generic brand and the brand name of the same drug, right? And the brand name is more expensive. So let's say the Tylenol is $7 and the brand name, store name acetaminophen rather is $4. You could save money and get the same pill, but people still buy the more expensive one, despite the fact that there's price transparency. Why is that? It's because they don't realize that the store brand is the same drug. It's just as effective. So the two things you need to know not only are the price, but also the quality. And by looking at this claims data and really leveraging the transparency that's already there with self-funding. You hear lawmakers and the president and everyone's talking, transparency. If you're a self-funded plan, you already have transparency. You're just not doing anything with it. And I love that about self-funding. Now you say, okay, that all sounds great, but can you actually do anything with it? Answer, yes. We were actually in the Boston Globe. This was a few years ago. I feel like, Married with Children, where he talks about like when he was in high school. He's like, I threw that touchdown pass. And he's still talking about like 30 years later. We were in a newspaper once, but about this program where we were not only able to identify which facilities are more cost effective as far as the prices that they charge, but also quality effective where there were fewer complications. And as a result, we're able to educate our plan members regarding, hey, if you're going to receive this type of treatment, it looks like this is probably your best bet. And believe me, talk about health benefits. This is the ultimate health benefit. Not only am I going to pay for your treatment, but I'm also going to help you make that all-important decision. You hear all the time people talk about how if they want to buy a television, you go onto Amazon, you check the reviews, this one's 5 stars, that one's 3. I'm so glad that this information is crowdsourced and everybody's giving me all this info. But if I need to get a procedure done and I need to pick a hospital, the only thing I can rely on is the billboard on the side of the road that was paid for by that hospital that says, we're the best at heart surgery. And I say, wow, well, if they say they're the best, they must be the best. So again, this transparency, the information that as a self-funded plan, we not only have, but can share with our plan members is priceless and is a benefit in and of itself. And speaking of benefits in and of themselves, one of the greatest benefits of being here at the Phia Group is being able to work with Brady Bizzarro. Brady?
Wow, that was a great transition, Ron. I think we only have like 50 minutes of love left to give in this webinar, but I'd be remiss if I didn't talk about the love that you can give as a self-funded plan to your SPD. And what better way to do that was an example recently, there's a court case about this, involving wilderness therapy. Now, many people listening to this webinar may not know what wilderness therapy is. Despite the grooting and growling from Ron, it does not involve animals directly, at least. It's actually a serious form of therapy for people. It's actually a definition I found online was that it's some kind of adventure-based therapy where, you model behavior based on a walk in the woods, for example. But it's supposed to be able to help change your mood. So maybe it's got a use. In the example I'm giving here, though, the plan did not want to cover wilderness therapy. So with a self-funded plan, you get to customize the language, your definition section, for example, in your plan. And so in this court case in Florida, where the court actually dismissed the case against the plan, but the plaintiffs were arguing for thousands of dollars worth of wilderness therapy claims. So a lot of wilderness trail hikes, I imagine, in this case. But the plan had a definition of residential treatment facility, and it was a pretty clear definition according to the court. It did not contemplate things like wilderness therapy. It didn't meet the requirements of the definition. So that was an example of where the plan set out, intended to not cover this particular service, wilderness therapy, constructed a definition to exclude those kinds of claims, and it was upheld in the court. What better outcome could you have? For a fully insured plan, you have virtually no control over the definitions of terms in the plan. They won't let you change things. So with a self-funded plan, you're allowed to make changes. You're also allowed to, generally speaking, shop for networks. So you have lots of options you can use. You can have limited networks. You can have no network. You could use a VUCA network. You could use pretty much anything you want. And Jen mentioned this before with respect to specialty drugs and RX claims, but if you want to cover no drugs at all, you don't have to. If you want to carve certain ones out, of course, looking at your network agreement to make sure you can do that too. So you have a lot of options. If you want to treat orphan drugs differently, that's fine. If you want to cover certain experimental drugs, like these FDA drugs that are coming out now to help children quit vaping, because literally everyone in our office behind me, I can see is vaping right now. So, and those are going to cause more claims, all the children we have working it. No, but seriously, it's an epidemic. You've probably seen it in the news wherever you live, but it's causing other more expensive health claims down the line. So if you want to cover an experimental drug that would help children to quit vaping, why shouldn't you be able to? And if you have a self-funded plan, you'll be able to do that. And for doing things like making plan modifications to your language, handling your claims and appeals, you know all the services we provide. I don't get too salesy here, given that we're pressed on time and the love we can provide. So I'll turn it back over to Ron to talk about some cost containment love that self-funded plans can give.
So speaking of wilderness therapy, Brady, I imagine that I'm at a campsite roasting marshmallows right now because you're on fire. Oh, there you go, buddy. I'm sorry. I apologize to everybody, just showing some Valentine's Day love. So one of the things that we talked about with data transparency is the ability to really pinpoint issues and address them. And you hear all the time people talking about sort of the dirty dozen, although I think there may be more than 12 here, I haven't quite counted. But the point being that we know in general what types of treatment or health needs are really the driving cost for these benefit plans. And you see them listed here, things like dialysis and specialty drugs, cancer, right, oncology, right, heart disease. And these are things that we know are major. These are the types of healthcare that people need volume-wise, but we also know are driving the cost of healthcare. But how? How do you know that this is what's driving the cost? And you know because you're getting the data, right? And the claims data is literally showing you, there you go, love that data, showing you, hey, this is more expensive than that thing. So otherwise, I mean, again, if you said to me, hey, Ron, what's driving up the cost of your grocery shopping? I could look at my receipt and say, aha, there it is, too many Rice Krispie treats. But here, you know, you say, hey, what's driving up the cost of healthcare for your plan? If you're not self-funded and you don't have that kind of data transparency, and you're just paying premium every month or every year, how do you know? You don't, right? The only one who knows is your carrier, and they're not telling. So if you have self-funded plan, you can look at the data and determine what's driving up cost. Additionally, if you're looking at monitoring the data, you may have the opportunity to stop payment in certain circumstances where a claim is very, very excessive and something looks to be off or wrong. Step in and actually negotiate down the price. So now not only are you identifying the cost drivers and making adjustments to the plan, contracting with centers of excellence, taking steps to avoid those costs in the future, but if you're timely, you're actually addressing those costs as they come in as well. I don't know about you, but I'm loving the self-funding. And speaking of things that I'm absolutely loving over here, how about we talk about the one, the only Brady Bizzarro. Brady?
Thanks, Ron. So I'm actually going to throw a little audible here, call an audible rather, and move to this slide first because it's about stop loss in general, but I'll talk about level funding briefly. But look, if you're a fully insured plan, you don't really care as much about risk because you're not really taking any on. You're paying a premium, of course, for that. But if you are a self-funded plan, you want to know, is stop loss right for you? And so this nifty graph we found here sort of shows you where the sweet spot is for stop loss coverage for self-funded plans. How many lives do they have? Typically between 200 and 1,000 is the sweet spot here. So I would advise you guys, these slides will be available, by the way, after the webinar, so feel free to look at them and you can see the data in more detail. But if you are a small self-funded plan, there are options for you too with regard to stop loss. That's where level funding comes in. And you can find definitions that are wildly different of what level funding is, but basically it's aggregate only stop loss. There's no spec deductible at all. It's coupled with advanced funding. The funds remain in the aggregate claim account, and at the end of the year, they're returned back to the plan or to the client. It's not much more complicated than regular ag coverage. And it provides a way for smaller plans to obtain stop loss coverage. So stop loss coverage, of course, is important, and I'll move ahead here to the important spot here, because it allows you, of course, to move your risk one level above you. And you can negotiate, of course, based on, you can use a broker, probably you should use a broker to do so, to find out which options are best for you, which options are best for your plan. Obviously, if you're paying a higher premium, you're probably going to be having more comprehensive coverage. You can pick the benefit period that's right for you. How long do you want? Do you want what's the word I'm looking for? When you have a coverage before or after a run out, thank you. Claims run out period, that can all be, that can be done. I'm on fire, Ron, you were right. There's plenty of options though, even for RBP. So you can have certain carriers that are more generous than others, perhaps, arguably, and we'll say, we'll work with a plan, they'll hold their claims open while you negotiate claims, but ultimately you get what you pay for. So be careful when you pick a carrier, but know that we love self-funding because you can really customize the type of policy you need that's right for you based on the size you have, the kinds of claims you have, and the amount of risk that you're comfortable with keeping. And with that, I'll turn it back over to Jen.
All right.
MIWA discussion, even more exciting than level funding.
Yeah,
Jen.
good stuff. So, Yeah, when this first came out, this rule came out a while ago, this change to the way that MIWAs and association plans would be permitted. It was giving the opportunity for a sole proprietor to maybe become part of a MIWA, or for some smaller employers that have similar businesses, even if it crossed state lines, to join together and create a common health plan. And there was a lot of hesitation and resistance with this type of change because people were unsure if it would actually work. But based on an article that Brady so kindly shared with me, there was a specific example that I thought was pretty interesting, that this actually is something maybe people should be more optimistic about this, and maybe this should be something that people are looking into. We do actually have some clients who have reached out to us that are having employers and common employers or a bunch of employers join together and create these MIWAs, and they're looking for help in not necessarily the plan design piece of it, but more broadly to have that type of plan actually being administered. So there is a real need for this, but it seems like some of these plans that have actually been created, they're not offering a really strict preventive care only plan design. They're actually offering more generous benefits that people anticipated. And it seems like they're actually offering these more generous benefits at a cheaper rate than it was anticipated. So I think there was one quote where a cooperative in Nebraska, I think it was offering a MIWA that was a pretty rich benefit for this plan design, and the premiums or the contributions were actually 25% less than what those same individuals would be able to find on an exchange plan with that same state. So I think we should be on the lookout for these and maybe see this as an opportunity for employers who may not otherwise be able or have the funds to create their own individual employer plans. Next, we're talking about subrogation overpayment. So there was a recent case, actually it was from just last month in January, this Peterson case, and we're talking about offsetting when there's the opportunity for a plan to recoup particular overpayments by offsetting claims, future claims for a plan, or even using a separate plan. And in this particular case, United Healthcare got into trouble here because they were not only doing this for in-network providers, but for out-of-network providers. And when you're looking to cross-plan offset, when you're taking claims from one plan and you're offsetting future claims on a totally different plan for a totally different set of plan participants, do you think that could create any fiduciary concerns potentially for those plan participants who weren't even actually part of that initial overpayment issue in the first place? Well, yeah, that's what the court is saying here. There could be some potential concerns, but the bigger impact here outside of the fiduciary concerns is, does your plan even allow you to offset across the plans in the first place? And not only does your plan allow it, but does the administrative services agreement allow the administrator to do that in the first place? So there's a lot of interest here, and I think that we'll be paying attention to this case as it continues to develop and some additional litigation continues on this particular cross-plan issue. And last but not least is when you have a self-funded plan, you do have the opportunity to incorporate and work with different vendors who can help in different ways, whether it's carving out services, helping with subrogation, or helping with overpayments. It doesn't matter, whatever the case is. You have an opportunity to take a look and see how they're doing and seeing if it's actually making a benefit, making a difference, making a change for your plan. If not, change vendors.
One of those things I like, or should I say love, about self-funding, Jen, and you kind of just mentioned it, is the fact that with these vendors, not only do you have to know what they're doing, but what they're charging you, again, because you have to be tracking all of the dollars. And one of the things that people say is a problem with self-funding, which is that fiduciary duty to monitor the plan assets. I actually say it's a benefit, because now you're legally being forced to keep an eye on where things are going. And at the end of the day, when your plan membership and people in general are saying, hey, what are you spending money on? You could say, I know exactly what we're spending your money on. Here it is. That, to me, that level of transparency is actually really special. And at the end of the day, I think when lawmakers and regulators look at the health benefits industry in general, and they see the amount of oversight and transparency that's inherent in self-funding compared to traditional fully insured products, I guarantee one of us is going to look really good and the other not. And all of the things you hear them promoting at the legislative level about transparency and innovation and cost controls, those things are already present in self-funding. And the last example right there, they talk about how they're now forcing hospitals to put their prices online. That's just one example where all of a sudden this idea of, hey, transparency is this great thing. For all the reasons we've discussed, be sure to go check out our podcast, check out our website, the media section. You'll find the podcast there. You'll get our in-depth feelings on transparency. But at the end of the day, if nothing else, it's a step in the right direction. And when it comes to going in the right direction, self-funded plans are a few steps ahead. So on behalf of myself, Brady, Adam, Jen, the entire Phia Group team, and everybody who's listening in, you're part of the team too. Thank you so much and have a great day.